Hello, everybody. Brian here from quantlabs.net. In this email, I'm going to show you 5 different sectors in the economy and the markets that have done very well and are uncorrelated. This is important to know that when I say uncorrelated, it usually will have no dependence on news, the stock market, crypto, all of that, where a lot of those I just mentioned are correlated around the performance of the general market. In this case, I've found these, and these are, as I said, really important to know that these should continue to move up, as you can see here. So these are the reports you'd get in what I call the deep analytics. I'm going to segregate them out into 10 separate sectors and categories, whatever you want to call it. And I'll talk more about that, but I just want to show some of the real big benefits you get with this. A couple of things you can get from this. So the first one we're going to look at is agriculture. We also have gold just as a learning lesson. We also have metals. We've also got real estate. And we also have crypto as another learning lesson here. So there's a bunch more that have done very well. A couple of factors to take away from this. I've said this before in my past videos. The yellow's the benchmark, which is the QQQs. And here's the Sharpe ratio for the last year. Okay, so all this performance goes back a year. And the reason it goes back to a year is you got a fairly decent reflection on what's gone on and what's dropped since 2022, what's recovering, what's not recovering, and you can get a general idea of where to put your money based around these category sectors. Now, if you join my service, the Deep Analytics, you'll be able to get a much better understanding where to put money. All of these are ETFs listed and supported on Interactive Brokers. These are all legit, mainstream, all that fun stuff. So let's go through some of these. So agriculture, there's certain agriculture. It could be one ETF, and from what I'm seeing, out of the 1,000 plus ETFs listed, supported in Interactive Brokers, I'd say 80% of them are not profitable over the last year. Now, if you go back the last few months, they may be profitable, but again, we may go back to where they go negative again because the markets are super volatile, or just maybe the market goes back in decline as these default potential rises and whatever else negative news, because it's all it's really been. Or the market's just going to a general range bound, which you don't want because you're not going to make money with that. So, in essence, this is an example of an uncorrelated uh, sector, agriculture. This is fairly defensive. And the thing is, when you get this combination of ETFs, whatever they are, don't ask because they ain't going to tell you. Uh, it's going to give you over the last year a Sharpe ratio of 1.05 and a pretty decent return of 26%, 27%. And then you get the benchmark, the QQQs, returning in the last year about 8.5%, which is normal, what we're getting. Here we're seeing the max drawdowns. They're all in line relatively. 16.84 for the agriculture, 21 for the S&P, or sorry, in this case, the QQQs. And those are sort of metrics from a high level. And the reason I call it deep analytics is because you can see here there's so many statistics that you can go through on the quarter or the drawdown average and so on and so forth. There's so much here. Now, the other thing I would pay attention to are a couple other highlights is what have the returns been over the last month? So agriculture generally is not a very strong sector, but it's relatively consistently profitable. At least you can see for this year, where it's been not a great performer, but generally it's done okay up until May, which is now May 27th here at 9:46, which I usually do. And only three negative returns out of 12, which is okay. 4 months out of the 12 months that we're not making money. But still, you can see the returns have been pretty good when you compound them. Okay, and again, these are all ETFs. So this is an important one to take away. Now, The reason I selected these other ones is I want to show you that learning lesson. Number one, this is crypto. So with crypto, you're going to get ETFs, trusts. That would include miners, something like Coinbase, some of the exchange related crypto plays, miners, and whatever else that are listed, and there's an ETF for it, or Bitcoin itself, or Grayscale being Ethereum, uh, block, Bitcoin, Litecoin, and a few others. This performance is all 100% purely Litecoin. When you factor all of the ETFs and trusts out there available specifically for crypto, the only one that's been profitable over the last year is a Grayscale Litecoin, LTCN, I believe. That's the only one that's been profitable. So here's the performance. You can see how volatile it is compared to the benchmark. It still did outperform the the QQQs. Here's the problem though, is that when you look at that Sharpe ratio, it's okay, but when you start factoring in this crazy volatility, you're gonna go, do I really want to hold this? I mean, look at the max drawdown here, 48%. That is obscene. You should want to hold something like this with this kind of max drawdown. You just don't want to do it. Again, we had an amazing January, decent February, and you can just see it gets weaker as time persists. But no, January was the time to hold it. So you do get some monster months, and usually, if you watch this every day as these reports come out, you'll be able to get an idea within the first couple of days of the month if it's going to be a really good ETF that you want to hold and plow more money into it as the monthly returns move up compared to other sectors, I guess you could call it, like the agriculture. So those are two relatively decent ones. So in here we also have, as I showed you, real estate. So here real estate's been killing the S&P, and look at that return here, 1.9, or sorry, the ratio, Sharpe ratio, 1.9. That's very strong. Also, we've got here very strong uh, return for the year. And you go, well, how's that possible? Well, here's the thing: is it's including every single real estate investment trust within within Interactive Brokers. And as I said, the ones that could be profitable could be the bearish ETFs, also not just bearish, but the ones that have leverage with bearish at 2 times or 3 times. So the question is this a bearish ETF or is this another type of ETF? There's usually, from my analysis, two ETFs that are driving this, and ones that you would never think of unless you're watching what I do. And you'd see that this sector is doing amazing, even though you wouldn't think it is, but it's doing amazing. And it's not commercial real estate. So that those type of ETFs are doing really well. I mean, that's an incredible Sharpe ratio, almost a 2 for the last year. So you can see here it's doing really well for 2023 in blue versus the QQQ. In here again, you can see it's been very strong year, very positive, but not like monthly returns that are going to blow your socks off. Now, I did put up a podcast, I believe, on what's the average return overall for most people that they'd be happy with. They'd be happy with 3%, right? So if imagine if you are in just in this one sector for real estate, you'd be up every month of the year, up 3% with 2 months double. So this kind of service would definitely pay back in spades knowing this information. And I said this before, this is just raw data, raw data. And these are just professional tear sheets that are built using this and comparing it against the QQQ. I don't want to use S&P. I don't want to use the uh, the Nasdaq, because it's skewed by the top 10 big tech firms. I've talked about them before. They skew the overall market. This one's a lot more realistic as a return with Qs. Okay, so I just want to make sure people understand that. All right, so knowing that, let's start going into the learning lessons. Number one, gold. You can see your gold kind of has been outperforming the benchmark here. Now, as the markets have gotten a little more hot in the last month or so, what happens to gold? It declines. So even though you're hearing, yeah, gold is going up, gold is kind of uh, at its peak. Uh, Out of the gold ETFs, there's only again maybe very small, maybe 10% that are profitable in last year. So focusing on only those profitable ETFs, that's why you're not getting this awesome uh, performance with gold. But yet, when the markets go up, gold declines. So this is what it's about timing, knowing what's going on with the market, stock market as a benchmark versus what gold's doing, and you see gold is declining. So it's fine to run up here and even outperform the benchmark of yellow and then peak and drop back when you hit a peak and you dump the ETF and then you go into something else that's going to give you a better return. Let's say agriculture as an example, right? So again, though, you can see how super volatile it is. Okay. And this is what you don't want. You don't want to be tied into those super volatile. And you would think, why is gold? Gold's not supposed to be volatile. It is. It does drop back. It's very ultra sensitive when the stock market performs well and then gold drops back. And sometimes you get gold uh, correlated around the performance of the stock markets as well. So kind of unpredictable. I'm more into finding these kind of returns. Even this is fairly volatile. And there are other sectors that are not volatile at all. Treasury's a good one, but certain ones that do well. And you don't even, it's just a straight line up with very few drawdowns. Those are the sort of places you want to be in. Whereas gold, uh, no. But this is pretty good as well. So that's a pretty decent play. And that's you're benefiting from real estate without having to go out physically own real estate and then paying your property tax, paying your 5% commission when you want to sell, and so on. It's just a better, smarter way to get a return. And you're already at a very good return for the year. 46%. Pretty hot stuff, right? With low volatility, you can get out whenever you want. You pay your exit fee, management fee, which is fairly reasonable. It's an ETF, of course. And then you get out. So you don't have to do any of the other crazy stuff when it comes to real estate. So gold, not doing too hot. When you look at the monthly, good, bad, good. So right there, this is very volatile. And then it settles down. And then let's look at the max drawdown over the last year. Average drawdown, 9%. Okay. Uh, what's the max drawdown of is a concern because that's how you can lose money very quickly. So again, that's why this is like the deep um, analytics. And when you're using a benchmark like QQQs, you could see here that the sharp is radically underperforming the stock market. Okay, I'm not giving you theories blown out of my ass. This is like realistically what's going on. This is not a great Sharpe ratio on the market, QQQ. So that's the benchmark. And looking at gold, profitable ETFs in gold is pretty bad comparatively. Let me remind you, there are a bunch of sectors that are unprofitable with a negative Sharpe. Obviously, you don't want to hold those. So here's another one that has done fairly well. The metals. January had a really nice run up here, um, especially between November here. You can see what happens. Boom. It takes a dip and up it goes and then dip it back and then comes back down. So if you're part of this, which I was and did pretty well, along here and you knew about it, you do very, very well. And again, look at the Sharpe ratio for this category. For this is again for metal, and this is including taking out gold and just including silver, some industrial metals, and so forth. So the Sharpe ratio is very poor compared to the market benchmark, the QQQ benchmark 0.43. Very important. As you can see here in the monthly returns, we're in the same boat as gold, but uh, just something to stay away from, unfortunately. So the next one we've looked at uh, crypto, we've looked at real estate, which is looking pretty good, but you gotta know which ones. You also got the commodity metal. Nice run up between November and January, good, but not after that. We've got here gold, which is not that great compared to the market. You can see here gold has dropped farther down than the strategy. And again, it depends upon the ETF, right? There's many, many ETFs that have not done well in gold over the while. Um, and commodity as well. Sorry, agriculture, I should say. That's performing pretty good. So again, when you look at this, that's definitely uncorrelated. The real estate, hard to say if it's related around the economy. You think it would, but looking if you knew what was here, you would go, "Whoa, how's that?" It's definitely uncorrelated when you know what's not, um, what is driving that, and it's very few bearish ETF. Anyways, if you like what you see here, which is really important, what I would do is go over to quantlab/books and get some free info. Guess I have to load up another browser here, but just go to that URL and get some more information, opt in to get more knowledge in what I'm putting out. Other than that, thanks for watching. Have yourselves a good day.